Hi, today we are starting with treatment of JLP. Okay, treatment of JLP. Listen, usually what happens in case of a death or in case of a retirement, what happens is we have to pay our outgoing partner in case of retirement and our deceased partner in case of death. I mean, we can't pay the deceased partner for sure, but his executors or her executor. Okay, so we have to pay them, no? We have to pay them. For that, we might be in need of sudden money, right? Because death will not come by asking, no? So we might be in the need of sudden money. Because if the agreement is there, and that mentions how you are going to treat those payment. For example, agreement says it should be paid within a year or it should be paid in an installment for the next 5 years. All those things are there, then it's fine. Otherwise, if agreement don't say anything, we have to pay our executor whenever they ask. If the agreement is not there, we have to pay the executor whenever they ask, or we have to pay the retiring partner whenever they ask. They might ask for that at the time of retirement only, no? So which means there sometimes due to the retirement and a death, there might be a need of urgent money, right? And it is an unplanned event. At least retirement can be bit of planned event, but death is completely unplanned event. What if agreement is not there, executor or a legal heir of a partner comes, deceased partner comes, and they will say, sir, listen, the partner was there, no, he is my husband or he is my dad or something. He gave his whole soul to the business. He didn't even keep a rupee in home. He gave everything to the business. Now to give payment to last rewards, we don't have any money. They might pay that way. And for your surprise, in your business also you are not having any money. Everything is blocked, right? So if that's the case, it would be weird, right? Because sudden payment, sudden needs it is. Without payment, they can't do the last rituals, right? They can't do the last rituals and all. So due to all those factors, what business will do is, business or a firm will take a insurance policy of its partners, and in case of death, what happens, insurance company will pay money, so the firm will receive certain money. With the help of that, we can pay our deceased partner's executor or we can pay our retiring partner. Okay, so the policy which is taken for all these things will be called as life policy of a partner. So now life policy firm can take it in two ways. Take it in two ways. Which are the two ways, sir? One, it can take on the life of separate partners. For example, A, B, C, D are the partners. For partner A, separate life policy. For partner B, separate life policy. For partner C, separate life policy. For partner D, separate life policy. So that is called a separate life policy. Whereas it can take on a firm also. Firm all together, firm. Okay, that could also be done. A, B, C, D. Everyone will be covered under a single policy. That could also be done. That is called as joint life policy. Okay. Now the question comes, sir, how much insurance company is going to pay? Insurance company can pay in two ways. One is maturity value, can pay maturity value, which is also called as assured value. The one more is surrender value. Sir, what do you mean by maturity value? Maturity value is the value which will be paid by the insurance company at the time of death of the partner or at the completion of the period of the insurance, whichever is earlier. I repeat, maturity value is the assured value given provided by the or paid by the insurance company in case of death of the partner or in case of completion of the period of the insurance, whichever is earlier. In all other cases, insurance company will not pay the maturity value. It will pay only surrender value. Sir, what do you mean by surrender value? What do you mean by maturity value? What are the differences? See, maturity value will be usually high. For example, you are paying a premium of 1 lakh rupees each for next 10 years. The maturity value of that insurance might be 25 lakh rupees. 25 lakh rupees. But surrender value is something which will be less than what you paid as a premium. Surrender value for first year will be 80,000, second year is, I mean, basically I can say 80% of what you paid. 80% of what you paid. I'm giving that 80% as just a numbers, like just imagine numbers. So 80% of what you paid. For example, first year you paid 1 lakh rupees, surrender value is 80,000 rupees. Second year 1 lakh, surrender value is, total you paid 2 lakh rupees, surrender value is 1 lakh 60. Third year you paid 1 lakh, so total became 3 lakh, surrender value is 2 lakh 40,000. Next year you paid 1 lakh, 4 lakh, surrender value will become 320, like that. Surrender value usually will be less than what you paid as a premium. So insurance company will pay the maturity value in two cases. One, expiry of the insurance time, I mean not expiry of insurance premium payable last date, not that. In that case it is surrender value only. Completion of the insurance period. Completion of the insurance period. For example, 25 years or the death of a partner, whichever is earlier. Okay. So yes. That's the case. Yes. So yes, maturity value is something which is paid at the time of death or completion of the insurance period, whichever is earlier. Whereas surrender value in all other cases, if business want to surrender the policy, boss, we don't want policy anymore, so please take it and give me whatever you can give. That is surrender value. So surrender value usually will be less than what you have already paid. Okay. Okay. So accounting point of view, usually there are two methods. Okay, method A, method B. And you also can say that in the method B again there are two methods. There are two methods, method A and method B. In the method B again there are two methods. Okay. What are the methods, sir? What are the methods? See, accounting, method A. In method A, what we will do is, we will take joint life premium paid, joint life policy premium paid as a expense. In method number 2, we take joint life policy premium paid as a asset, because of course in future we are going to receive some benefit for sure. Right? So that is JLP is treated as a asset, second method. First method is JLP is treated as a expenditures. Okay, done. And in JLP is treated as a asset, there are again two methods. One, maintaining the asset at a surrender value. Two, maintaining a reserve along with asset. Okay. In the first method, simple. Whenever we are going to pay the JLP, we are going to treat it as an expense. That's it, simple. What would be the entry? JLP premium account debit, because that's an expense, no, you are going to debit it. So JLP premium account debit to bank. JLP premium account debit to bank. This is what you paid. Now, as it's an expenditure, nominal in nature, or you can take expense and income. So, where you are going, what you are going to do? Are you going to take it to the balance sheet? Are you going to keep the balance of the account? Never. What you are going to do? You are going to write it off against the P&L, right? So, you are going to write off these expenditures against the P&L. So, the entry will be P&L account debit to JLP premium account. Okay, this is at the time of making a expenditures. Now, sir, what about the money which we received due to the maturity or surrender, whatever it might be? How we are going to treat it? Simple. The money we are going to get, no, bank account debit. The whole money will be distributed to the partners. Simple. To all partners capital account. Which ratio, sir? Profit sharing ratio. Old profit sharing ratio, you can say. All partners, like all the partners who are entitled for that. Sir, don't it is not only given to the deceased partner or a retiring partner. No. Why? Because as we have already taken it as an expense of the business, don't you think the profit of the business got reduced? Yes sir, profit of the business got reduced. Because of profit of the business got reduced, don't you think share of all the partners got reduced? Yes sir, share of all the partners got reduced. So while making a payment, the share is given to everyone. And while receiving the money, share is given to only one or two partner. Don't you think it's unfair? So what it is, as it is an expense of the business, as it's an income of the business, both at the time of expense as well as both at the time of income, debit and credit shall be given to the partners accordingly. Okay, it is not only for the retiring partner or a deceased partner, it is for all the partners whoever blocked their profit due to this thing. That's it. Method A is that's it. See here. And when make the on payment of a insurance premium, JLP premium account debit to bank account. JLP premium account debit to bank account, and that JLP premium you are going to transfer it to the P&L account, or you can say write it off against the P&L account. So the entry will be P&L account debit to JLP premium account. Okay sir, done. Next one. On the constitution of the firm, that is changes, certain changes you are going to make changes in the constitution of the firm. That time what you are going to do? See, usually practically speaking, you are going to surrender your JLP. Whatever the money comes will be taken by the existing partners in their existing profit sharing ratio before the new partner comes or before the partner retires. Okay, but yes, as they have given in the study material, this is what we are going to do. You remember reserves, right? That is, reserve are there in the books, and we want to maintain the reserve in the books after the admission also. That time how we treat it, same way. So simple, I will tell. First what we will do is, we will raise the JLP. We will raise the JLP and give the credit to the partners who are entitled for that. Just like our reserve. What we used to do with the reserve? Reserve account debit to the existing partners in their old profit sharing ratio, because that is their profit. So here also we will do the same thing. JLP account debit to existing partners capital account. Later that JLP account again we are going to credit, and we are going to debit the remaining partners or new partners in their new profit sharing ratio. Just like we are creating back our reserves with the new partners in their new profit sharing ratio. That is continuing partners capital account debit to JLP in the new profit sharing ratio. Okay. If you adjust, we are going to adjust it just like a goodwill. That is gaining partners capital account debit to surrendering partners capital account or sacrificing partners capital account. In case of death, what happens? In case of death, we are going to get a money, no? So JLP receivable account debit to existing partners, we are going to pay, give them a credit. Just like I told, no, bank account debit to existing partner, same entry. JLP receivable to existing partner, bank to JLP receivable. So if you cancel JLP receivable, entry will be bank account debit to existing partners capital account. Okay sir. Next one is what? Next one is JLP is treated as an asset. JLP isn't treated as an asset. Now under this we are not treating JLP premium as an expense, we are going to treat it as an asset. Okay sir, fine. We are going to treat it as an asset. Yes, we are going to treat it as an asset. So when we are going to treat it as an asset, we can do it in two ways. One, maintaining it at a surrender value. Two, maintaining a reserve for it. First we will learn how we are going to maintain it at a surrender value. Simple. When the insurance premium is paid, the entry will be simple. JLP premium account debit to bank account. Simple. JLP premium account debit to bank account. If it's a first method, that premium where you are going to pay, sir, that premium where you are going to write off, sorry, not pay, where you are going to write off, you are going to write it off against the P&L, no? So the entry would be JLP premium P&L account debit to JLP premium account. Expense it is, we have to write it off. P&L will become debit. So P&L account debit to JLP premium account. But here we are not taking it as an expense. Here we are going to treat it as an asset. So we are going to create one asset called JLP account. So we are going to transfer this premium paid to that account. So the entry will be JLP account debit to JLP premium account. JLP account debit to JLP premium account. Let us assume 1 lakh you paid. So when you paid JLP premium 1 lakh to bank 1 lakh. To bank 1 lakh. Done. Later you are going to transfer this to your asset account called JLP account. So JLP account debit 1 lakh to JLP premium account 1 lakh. JLP premium account 1 lakh. Sir, this is it? No. We have to bring it to the surrender value. Surrender value will always be less than what you paid as a premium. Sir, why we want to bring it to the surrender value? Conservatism concept. What does conservatism concept says? If it's a expenditures or a loss, you have to record it as and when you come to know. If it's a gains or a income, until you realize it, please do not record it in your books. So here, listen very carefully, maturity value is always a gain. For example, you are paying a insurance premium of total of 10 lakh rupees, you are getting a maturity value of 25 lakh rupees, which means 15 lakh rupees is a gain. Okay, maturity value is always gain. But surrender value will always be less than your premium paid. For example, you paid a 10 lakh rupees premium, so only 8 lakh rupees is received as a surrender value, which means 2 lakh rupees is loss. So you tell me, as per the conservatism, which we should take? We should take surrender value, because we should anticipate a future loss, not a future gain. If we are anticipating a future gain, we are just wishing for example, me along with some other 5 partners are there. We took the JLP. All of us are expecting one partner to die, so that we are going to get a maturity value, right? Which is very bad. So we should record it as surrender value. Okay. So, okay sir, fine. Let us assume surrender value of this is 80,000. Let us assume surrender value of this is 80,000. What we should do? That is loss. No, 20,000 is loss. 20,000 is loss. Loss where we are going to write off? In the P&L. So what we will do is P&L account debit to JLP account. To JLP account. How much sir? 20,000. 20,000. So JLP account balance is how much at the end of the day? JLP account balance is 80,000. JLP account balance is 80,000. This is surrender value method. This is surrender value method. See here. Approach 1, surrender value method. JLP account debit to bank account. Later P&L account debit to JLP account. Here premium they didn't take one account as a premium. I took it as a premium. Okay. So JLP P&L account debit to JLP account, and JLP where we are going to record it, or where we are going to mention it? We are going to mention it at a balance sheet in the asset side. At what price sir? At the price of surrender value. Okay sir, done. Next is approach 2. In this approach what we are going to do is, how much ever the JLP we are going to pay. So much amount we are going to keep it as a reserve. Reserve means nothing but appropriation of profit, right? So we have to get it from profit and loss appropriation account only. So we are going to keep certain money as a reserve, not certain money, same money how much ever we paid it as a JLP premium. Later JLP asset also will reflect, JLP reserve also will reflect. JLP reserve which side sir? Liability side. JLP asset which side sir? Asset side. Now in the second method, scenario 1, we wrote off the difference between the JLP premium and the surrender value to the P&L. No, here we are not going to write it off there. Here we are going to write it off against the reserve, because reserve is created out of profit only. No, at the end of the day the final effect will be same. But as we have already having a reserve for that, we are going to write it off against the reserve. Which means when you have kept a provision for your bad debt, first your bad debt will be written off against the provision, no? To the extent it is available. Additional things, if anything is there, that will go to P&L. Same way, as you are having a reserve, you are going to write off a reserve here first, later you are going to take it to the P&L. Listen, how this works, how the reserve method works, sir. Reserve method will work like this. When you pay the JLP premium, entry will be simple. JLP premium account debit, to bank. JLP premium account debit to bank. Let us assume 1 lakh. 1 lakh. In the method number 1, what we will do? We will transfer it to the P&L. Entry will be P&L account debit to JLP premium. In the method number 2, what we will do? We will transfer it to the asset, right? What will be the asset? JLP account debit to JLP premium account. So JLP account debit to JLP premium account. How much, sir? 1 lakh. Now in the method number 2, approach number 1, if the surrender value is 80,000, what we are going to do? The 20,000 we are going to write it off against the P&L. No, entry will be P&L account debit to JLP account. But in the approach number 2, not only this, we are going to pass one more entry. That is, we are going to appropriate certain profit as a reserve. So the entry will be P&L appropriation account debit. To JLP reserve account. How much, sir? Equal to what you have paid as a premium. That is 1 lakh. 1 lakh. Okay. This entry we will pass. Now what we are going to do is, at the end of the day, we will check out the surrender value. Surrender value is only 80,000. So the 20,000 in the first approach, we have written it off against the P&L. But here we are not going to do that. We are going to write it off against the reserve what we have already. So what we will do, simple, JLP reserve account debit, 20,000 rupees to JLP account. Now at the end of the day, in the balance sheet, reserve will come at what price, sir? Reserve will come at 1 lakh credit, 20,000 debit, 80,000 credit. So at the end of the day, reserve will come at 80,000 credit, which means liability side of the balance sheet. Okay. JLP will come at what, sir? JLP debit 1 lakh rupees, credit 20,000 rupees, which means debit balance of 80,000 rupees, which is asset side 80,000, which means JLP is shown at a surrender value 80,000. For that also reserve is maintained at 80,000. So this is second approach. Okay. So whenever the reconstitution happens, what we are going to do, when it is kept as an asset, whenever the reconstitution happens, first method will be there, no? I mean second method, first approach. In that, when the bank comes, asset is there, bank will come at a surrender value, entry will be bank account debit to JLP. Clear. That's it. Bank account debit to JLP. In the second method, second approach, bank account debit to JLP we will pass. So JLP will get cleared. What about reserve? That reserve we are going to share to our partners in their existing ratio. So the entry will be JLP reserve account debit to the to the partners capital account in their existing ratio. Okay. Reason is simple, boss. JLP itself is not there now. What we should do with JLP reserve, right? On the event of death, what you are going to receive? On the event of death, you are going to receive a maturity value. When you are going to receive a maturity value, how you are going to treat this, right? In the method 2, how you are going to handle this? In method 1, whether it's a maturity value or a surrender value, that doesn't matter. Bank account debit to partner's capital account, done. Right? But here, as your asset is reflecting in your surrender value, how you are going to treat it? Simple. When you receive the money, entry will be JLP account debit to bank account. You might receive more than what is there in the JLP account. That will be transferred to the profit. That will be treated as your profit. Okay. So, I mean, first method, second method, first approach it is. JLP reserve is not there. Okay. So, later that profit you are going to transfer it to the partner's capital. You are going to transfer it to the partner's capital. Okay. For example, your JLP is reflected at 10 lakh rupees. You are receiving a 14 lakh rupees. Now, bank account debit to JLP, you can write it as 1414 also, not a big deal. Later, JLP account debit for 4 lakh rupees to partner's capital account, 4 lakh rupees you can write. Or else you can do it like this also. Bank account debit to JLP, bank account debit 14 lakh, to JLP 10 lakh, to profit on JLP 4 lakh. Later that profit you can write it off against the partners. That is profit on JLP account debit to partners capital account 4 lakh. In their profit sharing ratio, old profit sharing ratio. You can do that way also. When the reserve is maintained, reserve first you should give it to the partners. I mean same what you have done in the first approach, same thing you do. Whatever there is in the reserve, no, that you transfer it to the partners in their profit sharing ratio. That is JLP reserve account debit to partners capital account. That's it. That's it. So I think we can go for question, right? Shall we see certain illustrations? Shall we see certain illustrations? Illustration number 21. Naresh, Rohit and Krishna are partners sharing profit and losses in the ratio of 2:2:1. On 1st January 2019, they took out a joint life policy of rupees 2 lakh. Annual premium of rupees 10 lakh was payable on 1st January each year. Last premium was paid on 15th January 2022. Rohit died on 1st March 2022 and a policy money was received on 31st March 2022. The surrender value of the policy as on 31st March each year were as follows. 19 0. Surrender value is 0. 2020 2000 rupees. 2021 5000 rupees. Show joint life policy accounts on 1st March each year, assuming that 1. Premium is charged to the P&L account every year. 2. Premium is debited to the JLP account and the balance of JLP is adjusted every year to its surrender value. That is method 2, approach 1. Just go through the question, guys. Just go through the question. We'll solve it. Reading question is very important, right? You should not start solving before reading a question once. You should read a question once for fun. Later you have to read and analyze. Later you should start answering. Sir, time waste, sir, time waste. Time waste is better than marks waste. If you don't read the question properly and if you do some mistake, gone, no. Later to rectify it, you will take the double time. Give me a second. Done. Listen, first we will solve under first method, that is premium is charged to the P&L every year, it seems. The premium is charged to the P&L every year. So JLP account, right? JLP account. Done. Listen what they are telling. Naresh, Rohit and Krishna are partners sharing profit and losses in the ratio of 2:2:1. Okay. On 1st January 2019, they took out a joint life policy of rupees 2 lakh. So the 2 lakh is a maturity value, or you can say sum assured. Annual premium of 10,000 was payable on 1st January each year. Okay. Last premium was paid on 15th January 2022. Rohit died on 1st March 2022. The policy money was received on 31st March 2022. Surrender value. Okay. The surrender value of the policy as on 31st March each year were as follows. 2019 nil, 2020 2000, 2021 5000. Show the JLP. Give me a second. Show the JLP account as on 31st March each year, assuming that the premium is charged to the P&L account every year, the premium is debited to the JLP. So premium is charged to the P&L account every year. So first when he is paying on 1st January 2019, right? So he is paying on 1st January 2019 JLP. So when he paid, what will be the entry? JLP account debit to bank account. So 1/1/2019 to bank account. To bank account. How much, sir? How much is paying? 10,000 every year, no? 10,000 every year. So 10,000. This 10,000 what we should do, sir? This 10,000 we are going to write it off against the P&L. Right? This 10,000 we are going to write it off against the P&L. So by P&L account. By P&L account 10,000. Okay, sir, done. Later again, next year, same story. They are telling no, on 1st of each and every year we have to pay. So next year is what? 2020, no? Listen, every year the same story continues. Okay, in the year 2020 again 1/1/2020 to bank 10,000, by P&L 10,000. In the year 1/1/2021 to bank 10,000, by P&L 10,000. In the year 2022 I think there is some masala. What is that, sir? 15th last premium was paid on 15th January 2022. So we paid a 15th January 2022, no payment. 15th January 2022 to bank account. To bank account. How much, sir? To bank account we received sorry, we paid 10,000 on 15th January. Okay. Listen, you are going to write it off to the P&L anyways. Sir, then you told masala, I will tell. By P&L account 10,000. Okay. Later, listen, Rohit died on 1st March it seems. Rohit died on 1st March 2022 and policy money was received on 31st March 2022. Okay. They are telling policy money was received on 31st March 2022. So on 31st March 2022 we will pass this entry. On 31st March 2022 we will pass this particular entry, that is bank account debit. How much, sir? How much we are going to receive? We are going to receive 2 lakh rupees, sir. So bank account debit 2 lakh rupees to all the partners. Who are the partners? Naresh, Rohit and Krishna. To Naresh account, to Rohit account, to Krishna account. To Naresh, to Rohit, to Krishna. Ratio, sir, ratio is 2:1. 2:1. So 2 lakh divided by 5 will come to 40,000. 40,000 into 2 is 80,000. 80,000 and 40,000. 80,000 and 40,000. Under first method, this is the thing what we are going to do. This is it. Finish. Done. Okay. Under the second method, now we have to see. Second method. That is where we are going to keep our JLP at a surrender value. I think it will be small. Give me a second. Oh, in this date column is not there. Give me a second. JLP account. Okay, we'll go one by one. Okay, sir. What is happening? On 1st January 2019, they are paying a premium, no, first premium. So 1119 to bank. How much it is? Premium 10,000, no? 10,000. Okay, done. But the thing is, at the March 31st, 2019, the surrender value is nil. Which means whole amount of premium, what you should do, sir? Whole amount of policy you are going to transfer it to the P&L account. Because surrender value is nil. Premium value is 10,000. Surrender value is nil, which means 10,000 should be written off against the P&L account. So on 31/3/19 by P&L account 10,000. By P&L account 10,000. Okay. Later, what is happening? Next year, that is 1/1/20, we are paying a premium, right? So to bank account. How much we are paying, sir? We are paying 10,000 rupees. But next year, is there any surrender value? Yes, 2,000 is a surrender value. which means you can keep a balance of 2000 and you have to write off 8000 to P&L. So on 31/3/2020 by P&L account, 10,000 minus 2000, you have to write it off 8,000. By balance carried down, how much sir? 2000. By balance carried down is 2000, total comes to 10,000. Later, next year again you are going to pay. So JLP account debit to bank account, that is on 1/1/2021, right? So 1/1/21 to bank account, JLP account debit to bank account 10,000. Next year, how much is the surrender value of your policy? 5,000 is the surrender value of your policy. So on 31/3/21 by P&L account, wait, there is a balance, no, this year there is a balance, sorry, two balance brought down. This is what 1/4/20, two balance brought down, 2000 was a balance. Okay, so by P&L account, how much is your total balance? How much is your total balance? Or you can just make it as balancing figure, and here by balance carried down, how much is your surrender value? Your surrender value is 5,000, no? Surrender value is 5,000. So total will come to 12,000 minus 5,000, which will be 7,000. Okay. Next year you are going to, first two balance brought down will be there at the rate of 5,000. That is when 1/4/21. So on 15th of January 21 you are going to pay a premium, right? So to bank account, how much you are paying sir? You are paying 10,000 rupees. Okay, later what is happening on 22, on 31/3/22 you are going to receive a money from your insurance company, that is by bank account. How much you are going to receive? Whole 2 lakh rupees you are going to receive. Okay, money which had come is 2 lakh rupees. The balance of your policy is 15,000 rupees. Abba, lottery brother, lottery, income tax, right? So 2 lakh, 1,85,000 you have to transfer it to P&L. Sorry, not P&L, partners capital, because their money it is, to partners capital account. Who are the partners? Partners are NRK. What is the ratio? Ratio is 2:2:1. So 1,85,000 divided by 5. 180 divided by 5 is 36,000, 37,000 into 2, right? Yes, 37,000 into 2 is 74,000, 37,000. Okay, so this is how JLP account will get reflected under the second method. JLP account will get reflected under the first method. Hope it is clear. Hello, is it clear? Yes, copy down. Okay, copy it down. I am giving 2 minutes for this method and other 3 minutes for that method. So yes, I'm scrolling it. Okay. This is better. And one more thing, when the separate life policy is taken, the partner who will die, for him, I mean, his portion of life policy will be at a matured value, whereas the partners who are still there, their SLP will be at a surrender value. Okay, their SLP will give you surrender value, whereas the partner who deceased, his value will be maturity value. Whole together we will take and we will share it to the partners. We will take the money like collection, like maturity value plus surrender value, surrender value, surrender value in case of 4 partners. Together we will get certain money, no, that you are going to share it to their profit, partners in their profit sharing ratio. It's not something like the guy who died, he should get whole maturity value. No. Although it is coming because of him, still it is expense of business, no. So it should be bared by, I mean, it should be given to all the partners because the expense is paid by business. I mean, again, all the partners. I'm just scrolling a bit. This question might come in a MCQ or a true or false also. You never know. Not this question, I mean JLP questions. Fine. That's it. Hope you understood JLP, right? Okay. We'll see in the next concept.